The hashtag on our Twitter right now is financial markets. And of course, we are still talking about the headlines. Now, moving across East Africa, of course, we've had several increments in prices, but in particular, there are commodities that have, of course, outdone others in terms of increasing share price. Of course, this includes the oil products. Now, East Africa is facing a shortage of raw materials to manufacture cooking oil, soaps, and cosmetics, which, of course, have no clear signs of availability of such commodities in the next 10 days, even as prices of the same commodities soar, adding to consumers' pain. But, of course, it is the high prices and shortage of edible oil that is cooking up a storm across the region. Data available to us shows that no edible oil-related imports are expected in Kenya this month. According to the Mombasa port ship schedule, more than a dozen vessels are expected to dock laden with different products except for palm and vegetable oil, which are key ingredients in the manufacture of cosmetics, soap, and of course, cooking oil. In the port schedule for June 6th, 2022, 14 ships are expected to dock in the port schedule between June 6th and June 20th, 2022. 14 ships are expected to dock carrying containerized cargo, that is about cars, clinker, bagged rice, bulk wheat, fertilizer, and steel products. Now, records from the Kenya Ports Authority indicate that the last palm oil and vegetable oil tankers, MV Maritime Vanessa and MV Navigating 8 Guard, respectively, docked on the port on May 19th, 2022. Consumers have endured the rising prices of cooking oil, blamed on COVID-19, the ongoing conflict in Ukraine, and the deficiency of dollars, which has seen at least 2 Kenyan oil manufacturers reduce operations due to their inability to pay suppliers and get raw materials. This week, Pwani Oil and Kapa Oil refineries announced cutting down production in the coming weeks due to the dollar crisis. Given the prevailing challenges, Pwani Oil has temporarily halted operations at its refinery in Kilifi as they work to resolve the problem. They, however, wish to assure their customers, employees, suppliers, partners, and other stakeholders that this is a temporary measure and the business remains in operation and their products remain available in retail outlets. That's according to a public notice by Pwani Oil Commercial Director, Mr. Rajul Maldi. Now, a certain Kenyan newspaper found operations at the Kilifi plant this week going on, but sources there indicated that there might be no more raw materials by mid-June. Kapa Oil refineries also cited a dollar shortage amid raw material rationing by suppliers abroad. Their operations have been hampered by dollar scarcity and the inability to access the raw materials. That's according to Kapa Oil marketing manager, Mr. Sid Shah, in a statement he gave out to the people in Kenya. John Muriki, who is the Mombasa-based palm oil dealer, confirmed the shortage supply of palm oil, which is a key ingredient in the manufacture of edible oil. The announcement by Indonesia to suspend exports of palm oil affected the cost of key products ranging from cooking fats to soap and cosmetics. They have also had challenges importing these products. That's according to Mr. Muriyuki, who is, of course, from the Mombasa-based palm oil dealer. And then Indonesia has since lifted the ban on exports, but the government wants producers to supply the local market before resorting to exports. With the Kenyan companies hard up for dollars, consumers are bracing for further shortages and price increases. Pwani Oil's Mald told there a certain publication called Business Daily in Kenya in an interview published Friday last week that banks were only allowing the firm half of its dollar needs as it battles it out with other buyers of the Malaysian products. Added to that, they don't pay on time, and so they don't get prioritized in supply. According to, of course, the Boss Talk, prices have already risen over 50% in just the past 6 months, as factors such as labor shortage in Malaysia, to drought in Argentina and Canada, which are the biggest exporters of soy oil and canola oil, respectively. Of course, those are the affected exports. Price jumps. Of course, the manufacturers are now buying palm oil at between $1,760 and $1,980 per ton. However, before the Ukraine war, the commodity retail was about $1,490 per ton, having more than doubled from $700 per ton before the onset of the COVID-19 pandemic. The price jump driven by the pandemic was blamed on export restrictions by Indonesia, and of course Kenya Edible Oils subsector chairman Abdullah Ghani Alwoji in an earlier interview said that COVID-related factors such as jump in price of a 20-liter jerrycan from $22 to $45 under 2 years and the ban of export by Indonesia will aggravate the problem. The edible oil subsector needs more than $100 million every month to import raw materials, and consumers, industrialists and economists are calling on the Central Bank of Kenya, that is CBK, to intervene on the dollar issue, even as the central bank insists that there is no shortage. Others are rooting for local solutions to ease dependence on the imports. Now, according to Mr. Mandera, Senator Bilo Kero, who is, of course, who is an investor in the subsector, called on the Central Bank of Kenya to allow commercial banks to sell the dollar at the market price. Of course, there is a serious dollar shortage, but the government has decided to bury its head in the sand, and commercial banks are not selling because the Central Bank of Kenya has decided to set a price control on the dollars, according to Mr. Kero. The Central Bank of Kenya governor knows what is going on, and businesses, not just manufacturers, are facing a huge challenge. Kero also said if there was normal demand and supply, the dollar would be selling at about 123 Kenyan shillings. But the government doesn't want that because it would have to spend 40 billion Kenyan shillings. That's about $341 million more in servicing its debt. Kenya's debt is predicted to pass over the 9 trillion threshold mark. That is 9 trillion Kenyan shillings. That is about $76 billion this year, as the country's reliance on domestic and external financing to fund spending continues. This past week alone, Parliament allowed the government to revise the debt ceiling to about 10 trillion. That is about $85 billion. Treasury estimates show that public debt stocks is expected to hit 8.6 trillion Kenyan shillings. That's about 73 billion at the close of June 2022, and before rising to 9.5 trillion. That's 81 billion next year in June. There are serious concerns here, of course, and of course they have called for a meeting between the manufacturers and the government this week. Of course, that's according to Mr. Kero. And the immediate solution is for the Central Bank of Kenya to lift the controls. The risk assigned to Kenya's sovereign bonds by international investors has gone up in the past 9 months, meaning that the country stands to pay higher interests if it floats a new Eurobond under the current market conditions. In view of this, the National Treasury cancelled a $1 billion Eurobond that had been opted for, that actually the government had opted for syndicated loans from commercial banks after receiving bids priced at about 12%. Ken Gichinga, who is an economist at Metoria Economics, said that the Central Bank of Kenya has to look at price stability, as they will not want the shillings to depreciate at such an exorbitant rate. The Central Bank of Kenya has dollars reserve, and there is 5 months worth of reserve, which is way above the limit recommended. So they still have some latitude to release some more dollars in the market. To avoid a perennial dollar shortage in the country, Mr. Gichinga advises players in the edible oil subsector to incorporate local raw materials in their business model. They should have both long-term and short-term plans. And of course, the short-term plan is to have some negotiations with the Central Bank of Kenya over the dollar shortage, and the long-term plan should be a more sustainable and resilient plan in terms of supply chain and accommodating both local and international players so that they can easily switch in case of issues such as the ones happening right now. Now, in Uganda here, this has not left us the same as well. In Uganda, the retail price of cooking oil passed $4 per liter mark last month. Now, $4 is about 12,000. That is 4 times 3,000, yeah? And I'm just calculating the bare minimum. That is last month. From about $2.2. That's about 6,000, 7,000 for every liter. And supermarkets are charging around $3 per liter, but the supply remains a challenge. Now, according to President Yoweri Museveni, during his State of the Nation address for the country last week, he acknowledged the crisis, but suggested local remedies. Of course, he, and I quote, he said, when it comes to the recent high commodity prices caused initially by the relaunch of the world economy after the 2 years of lockdown, and additionally by the war in Ukraine, our decision, after careful analysis, is to avoid the trap of tax cuts and subsidies, he said. He also added that instead, we are doing 2 things. Number 1 is to engage, and I'm quoting the president here, number 1 is to engage the global actors that have caused these artificial shortages. And of course, he says, I have contacted some of the actors. And the other one, the second way, is to get our own substitutes. That is including cassava and banana flour for bread, and our own sunflower, soybeans oil, as we wait for our more quantities of palm oil from Sangobe, Mayuge, Buvuma, Maruzi, and Bundibujo, etc., he added. Cutting taxes and or giving us subsidies, especially on imports, is suicidal, according to Mr. Museveni, because our people may buy carelessly and we end up draining our forex reserves, and moreover, cutting taxes or subsidies or subsidizing means taking away money from planned projects and putting it into consumption. Now, that was the view of Mr. President Museveni, saying that tax cuts or subsidies will be disastrous, and they will not actually help the economy. They will just leave the central bank reserves bleeding with nothing to run back onto. And he also brought the issue of projects that government has been planning to run for the past couple of months, saying that these as well will be affected. And of course, now we are in a place where we don't have any subsidies or tax cuts at the moment. Now, Tanzanian President Samia Suluhu on Thursday ordered authorities in Kagera region to set aside between 70,000 to about 100,000 hectares of land for a massive cultivation of sunflower and palm oil to end the shortage facing the country currently. Now, Tanzania's annual consumption of edible oil is about 650,000 tons, but the local production capacity is about 290,000 tons annually, official statistics show. And Tanzania has depended on imported edible oil, and the country experienced an acute shortage of the commodity during the pandemic when countries producing edible oil closed their doors. That's according to someone from Kagera Sugar Factory. Then the president said that to end the shortage of edible oil in the country, there must be a massive cultivation of sunflower and palm oil, noting that Kagera possessed huge tracts of arable land that could be used for the project. Now, Confederation of Tanzanian Industries Trade Policy Specialist Frank Daffa, commenting on the budget proposals for the 2022-2023 fiscal year, called for tax policies that favor investors. They suggested that import duty on edible oil be slashed from 25% to 10%. That's according to what happened in Tanzania. As you can see, the issue of prices of oil is all over the region, with Uganda and Tanzania not being an exception. But everyone is trying to create solutions. And of course, Tanzanian President Ms. Suluhu has said they are setting aside over 70,000 to 100,000 hectares of land from Kagera Sugar Factory, where they will be cultivating sunflower to be able to start producing, increasing the capacity at which they are producing their own oil from their own raw material. And I think that's something as Uganda we should as well consider, following the president's advice on using our own binazi from the islands of Buvuma and Kalangala, and using our own sunflower from, of course, different districts that are favorable for the growth of sunflower. We could start using our own basic raw materials here instead of relying on palm oil from Indonesia and Malaysia, which are not coming in handy right now. So as we can avert the problems that come due to shortage of these raw materials. Remember, commodities have been increasing in price, but in particular, commodities that are based on raw materials such as palm oil have been hit very, very hard, including cosmetics, that is including Vaseline and other jellies, lotions, and so on, as well as soaps, that is bar soap, washing soap, bathing soap, and the like, but most fundamentally cooking oil, which is almost part of most meals that are made. It's kind of becoming very difficult to access a liter of palm oil, with prices ranging now from 10,000 to 12,000, 13,000, and so on, down from, of course, up from 7,000 before this Russia-Ukraine war and stuff like that. And of course, there are very many factors outside our control, and probably we need to create short-term and long-term solutions, as already mentioned. But one of the long-term solutions we could actually create for this case is first and foremost making sure we can produce using our local raw materials instead of relying on the imported raw materials from other countries. Because remember, the problem with importation as well is our exchange rates. The more we import, the more we weaken our shillings, which is already struggling against the very strong dollar right now, right? And so if we are to still, in the long term, solve the problem, we must depend on our local. We must depend on the local, raw materials here and produce our very own from our own raw material. That way, probably we will address the problem. But in the short term, the central bank could come in and help a little bit, but this will not help us for so long. It will only hold up as much as it can, but not for long. We are going into a short break. When we return, we'll probably return with Mr. Luis Chizito, who is a lawyer specialized in fintechs. We're talking cryptocurrency, we're talking money, we're talking investment, and of course, the law. Don't go anywhere. We'll be right back after this short breather.